contact a broker or tell the computer or the broker that I want to buy or sell my shares, and the financial markets will make sure that lots of buyers or sellers will see my offer. These markets are set up so that buyers or sellers must compete with each other to give me the best price. The genesis of the New York Stock Exchange was way back on May 17, 1792, when 24 stockbrokers got together under the now famous Buttonwood tree in front of 68 Wall Street. All 24 signed what became known as the Buttonwood Agreement. They set the rules for buying and selling the stocks and the bonds that are fundamental to the financial industry. Today, we enjoy the benefits of efficient, low-cost securities markets. Our ancestors didn't have it so good. Trading stocks was expensive and slow. Communication was more difficult, record keeping was done by hand, and lots of paper had to be mailed back and forth. From that modest beginning under the Buttonwood tree, stock markets have undergone an explosion in their influence on our economy. The financial services sector comprised just 2.8% of the United States gross domestic product in 1950. In 2006, just before the financial crash of 2007, it had grown to 8.3%. Growth in trading volume is even more dramatic. According to the World Federation of Exchanges, the dollar volume of stocks traded on the New York Stock Exchange, now often called the NYSE, about doubled from 1997 to 2000, then followed up by tripling from 2000 to 2008. From 2001, when Shanghai first made the list at just under 300 billion, until 2008, Shanghai's trading volume jumped 9 times its 2001 volume to 2.6 trillion. From 1929 to 2009, the total trading volume of stocks in the Dow Jones Industrial Average doubled about every 7 or 8 years. And starting early in the 21st century, it began doubling about every 3 years. All of that increase in trading volume hasn't been uniform across the world. In 1990, the New York Stock Exchange headed the list of stock exchanges ranked by trading volume. The Tokyo Exchange was second, while the London and Frankfurt exchanges ranked third and fourth. The National Association of Securities Dealers Automated Quotation System, or NASDAQ, which is essentially a computerized trading system, was less than 20 years old and ranked fifth. Shanghai wasn't even on the list of the big exchanges in 1990. By the year 2000, though, the advantages of the NASDAQ system had rocketed it to the top of the list of trading venues, and by 2010, Shanghai was beginning to flex its muscles as a world financial center, mostly at the expense of European exchanges in Tokyo. Those exchanges were still growing in trading volume, just not fast enough to keep up with Shanghai and the NASDAQ system. For now, New York, the home of both the New York Stock Exchange and the NASDAQ system, remains the financial center of the world, at least as measured by stock trading volume. Shanghai is making a big splash, though, and given the rapid development of financial markets in China, that's likely to continue. Europe and Tokyo show some growth in volume, but not enough to hold their relative positions on this list of 6 major exchanges. These stock markets are interrelated. Some stocks list on more than one exchange. Daimler AG, the parent of Mercedes-Benz, listed on both the Frankfurt and New York Stock Exchanges for many years. Generally, investors find it easier to trade on an exchange in their home country. The World Federation of Exchanges says the trading volume on the New York Stock Exchange and its related exchanges totaled over $33.5 trillion in 2008. Some people are wondering what companies can possibly do with all that money. The answer is that they aren't getting that money. Almost all of that trading volume is in what's called the secondary market. The secondary market is like the used car market. If I sell my car to you, then you pay me. The manufacturer, Nissan or Ford, doesn't get anything. Why should they? It's my car, not theirs. It's the same thing with stocks. if I sell you my Ford shares, then you pay me not